Good morning, welcome to the ADS Securities Markets Update. We'll start again today with a look at the recent or latest economic releases from the US before looking at the Asian session and the upcoming sessions today. The US economic releases yesterday came in line with our estimates, and all the economic figures came in also with another disappointment, easing the speculation for a sooner rate hike by the Federal Reserve in June. And these figures also posed the US dollar rally and gave equities a greenish beginning of the week, and Dow Jones basically increased by more than 235 points, while S&P added more than 25 points so far. First, or beginning with the US figures today, and first of all, the Empire State Manufacturing Index unexpectedly fell towards 6.9 in March, down from 7.78 in February, despite the fact that it had been anticipated to rise toward 8, and this is basically the second monthly decline in a row and the lowest reading since December of last year. Secondly, the Empire State Manufacturing Index, the new orders component, posted also the first monthly decline since November of last year, declining by or toward minus 2.39 in March, down from 1 point or plus or positive 1.22 in February, and this is the biggest monthly decline since November of 2013. Third, the industrial production also increased way less than expected, rising by only 0.1% in February, despite the fact that the estimates for it had been anticipated to rise by at least of 0.3%. Moreover, and more surprisingly, January's reading has been revised lower from a growth rate of 0.2% to a decline of 0.3%, which basically also increased the speculation for another revision to the downside for Q1 GDP. Fourth, the industrial production outputs in the US unexpectedly slunk by 0.2% in February, while it had been anticipated to remain unchanged. Moreover, the January's reading has been revised even lower, again from a growth rate of 0.2% to minus 0.3%, and this is the third monthly decline in a row, one that we have not seen since 2009. Fifth, the capacity utilization rate also unexpectedly declined or fell towards 78.9 in February, while the estimates pointed to a rise towards 79.5. January's reading has been also revised lower, again towards 79.1 instead of a rise of 79.4, and this is the third monthly decline in a row and the lowest since February of 2014. Finally, the NAHB Housing Market Index came in contrary to the market expectations, also declining toward 53 in March, down from 55 in February, despite the fact that, again, it had been anticipated to rise toward 56, and this is the third monthly decline in a row and the lowest reading since June of 2014. The US dollar rally was posed yesterday, and it declined almost across the board, especially after these figures, and this is because March data was supposed to show some recovery, including the Empire State Manufacturing Index, in addition to the housing data. However, yesterday's figures confirmed a major slowing down, and one that has even exceeded the market estimates. In the meantime, the Federal Reserve is likely to ease the positive tone or the hawkish tone following the recent data, and traders are likely to be very cautious ahead of the FOMC's meeting this week, and we believe that it is better to stand aside until then. The crude oil yesterday also, the West Texas crude fell yesterday to another 6 years low, trading below $43 and reaching as low as $42.80 so far, and this has also occurred because as the people are hoping for a deal between the US and Iran in the next few days. Brent crude also took the hit yesterday with more than a 3.3% of decline yesterday toward 52.50, and Iran noted that it could raise its oil export by 1 million barrels a day if sanctions are lifted. And in the meantime, it is all about the global data, which remains weak across the world, while OPEC is unexpected or not willing to intervene before June's meeting in the next few months. As for the Asian session today, there were two major events from Australia and Japan which had notable impacts on the market. Beginning with Australia, the Reserve Bank of Australia monetary policy meeting minutes showed that the bank is ready to intervene again by cutting the rates, and the bank noted that further rate cut may be appropriate over the period of time or the period ahead, and the case to cut the rate further may emerge on the current inflation and the growth forecast. The Aussie weakened also again, as the bank reiterated that despite the recent decline in the Aussie against the dollar, it is still not enough, saying that it's still above most of the fundamentals value. The Aussie dollar eased back from 76.50 to as low as 76.15. However, this is a key support area which is seen as a key again for further declines. Otherwise, another rally could be seen above or amid the continuous disappointment from the US towards 0.77, 77.30. This is also possible. However, again, a tight range could be seen or more likely ahead of the FOMC decision this week. In Japan, the Bank of Japan again decided to keep the current stimulus package unchanged as widely expected. However, one of the members voted against the decision and saying that he prefers the pre-October policy target. And moreover, the bank noted that the core CPI is unlikely or likely to remain between 0 and 0.5% year on year. But for now, or for the time being, the bank believed that year-over-year CPI, or core CPI, is likely to remain around 0 for some time. The Japanese yen advanced slightly across the board. The dollar yen remains within the same tight range since last week, around 121.40s, and last week a close remains bullish for the pair and looking for a breakout above the recent high, which was around 122. But in the next few, however, again, a tight range could be seen ahead of the FOMC meeting minutes. As for the European session today, a few economic figures will be released from Germany and the Eurozone, which may have also only a medium impact, but again, a short-lived impact. In Germany, the ZEW economic sentiment is expected to rise again toward 58.9 in March, up from 53, which would be also the 5th monthly increase in a row and the highest reading since January of last year. For the Eurozone, also the ZEW economic sentiment is also expected to rise again toward 58.2, up from 52.7 during the same period between March and February, which would be also the 5th monthly increase in a row and the highest reading since June of last year. Moreover, the final CPI, or the Eurozone final CPI and core CPI, is likely to remain unchanged at minus 0.3% and a plus 0.6% respectively for the month of February. And finally, the Eurozone quarter-over-quarter employment change may rise only by 0.1% in Q4 of last year, comparing to a rise of 0.2% in Q3 of last year also, which would be the weakest increase since Q4 of 2013. Finally, in going forward to the US session today, there are also a few economic releases from Canada and the US, which is likely to have a major impact, but again would be also a short-lived impact ahead of the FOMC meeting minutes. In Canada, the manufacturing sales is expected to decline again by 1.1% in January, after rising by 1.7% in December of last year, which would be also the first decline in almost 2 months. In the US, we will be focusing on some housing data again today. The housing starts is expected to decline by 2.4% in February, after declining by 2% in January, which would be the second monthly decline in a row and not seen since mid-2014. Finally, the building permits in the US is expected also to rise by 0.5% in February, after declining by 0.7% in January. Despite these estimates, there is also high probability for these numbers to disappoint, in line with the other economic releases since the beginning of the year. And this is also for today. There is no technical update or new trades for the week as we wait for the FOMC decision. However, you can always read our daily technical analysis on ADS Securities website. Stay tuned this week, as we will be publishing also a special report for the FOMC meeting minutes, or the meeting or the decision that we are waiting this week, showing why we believe that the Fed may remove the patient from its statement, but will likely replace it with something or another or similar word to patient. This is it for today. You can follow us on our social media sites, Twitter, Facebook, and YouTube, to get the latest economic releases, reports, and analysis. You can like and share this video. Thank you for watching. I'll see you once again tomorrow.